Hey, what's going on, everybody? I am here with you today. Want to talk about getting yourself in a great position. Yesterday, we got to touch. By the way, I'm here with my good friend and colleague, Ryan Patient. So, one of the things I wanted to touch on, which I thought was really important, is a follow up from yesterday, right? Talked about what's going on in the economy and stagflation, what that means. And so, I also left off with focus on what you can control. All right. And so cleaning up credit card debt is something you can control. Starting your business is something that you can control. And I wanted to get on here with Brian because he's my lead guy when it comes to this, and talk about how you can clean up your credit card debt and how you can utilize the services essentially to start a business. And it's a lot easier, quicker, faster than getting an SBA loan. So Brian, let's talk a little bit about credit card debt before we get into starting a business.
Yeah, well, I will tell you this. I mean, credit card debt is something that I would say almost everybody in existence has dealt with,
Yep.
in one way, shape, or form. Personally, I've gone through it multiple times. Every time I would get out of debt, I'd be like, "All right, cool, never again." And then I bought a house. I'm like, "All right, so got to buy this, got to buy that." So, and then next thing you know, you got like 20 grand with a credit card debt. That's when I kind of learned about the whole process of, what the difference was between debt consolidation, debt settlement, everything. Um, and that to me, like what blew my mind was how much money I was actually paying on the credit cards.
Hmm.
So I think we had like 4 or 5 different credit cards. We're paying about $900 a month, and we weren't really seeing the needle move at all on
Yep.
the balances. And we got approved for a loan, it was like a $20,000 loan, paid off all the credit cards. It was a 3-year term, right? It got like those 5 payments into one payment, and we reduced what our minimum payment was, like 637 or something like that a month. So all in, like, we consolidated that debt, made one payment, and then we actually saved like $300 a month that we could apply towards other things,
Yep.
right? So it was a huge benefit.
Well, let's talk
And
about the trap. Sorry.
no,
Let's
no,
talk
go
about
ahead.
the trap because a lot of people fall into this. Credit cards are great. They basically, if you use them properly, business or personal, they're going to give you a free 30 days of float, right? The challenge runs in when you don't pay them off at the end of the month, right? Because then you're getting charged interest. And a lot of people, if you look at your statements, if you're just paying the minimums or twice the minimums, that interest starts compounding. So yeah, I mean, I have credit cards at 8%. I have them at 15%. When that starts compounding, it is very, very hard to chip away at that principal. And so what happens is get on a slippery slope of it's almost impossible to break that cycle where you're constantly just paying, the minimum, twice, 2 times the minimum, 3 times. And what could take you, it could take you 5 to 7 years to pay off everything. And by the time it's said and done, you could be paying off 3 to 5 times the amount or maybe more, depending on how you're paying down the cards. So that's what we want to help people clean up, especially going into this. And one of the ways that we do that, what Ryan was referencing, is a term loan to consolidate. So talk to us a little bit about that.
Absolutely. So the way that the term loans work is it's a monthly payment, it's simple interest. So that's the big difference between what you're talking about with a compound interest on the credit cards. This is simple interest, like a car loan or a mortgage, like what you would normally think interest would be. Like I said, there's monthly payments. The term ranges anywhere between 24, potentially out up to 84 months. So between like 2 and 7 years, no prepayment penalties. So you can always pay these loans off ahead of schedule. But ultimately, I mean, it's kind of a win-win scenario, right? Because you don't have to close out your credit cards, which is big. That's a plus. If you close out your credit cards, let's just say you have $20,000 worth of credit card debt, you pay them off and then you close them out. What's going to happen is people think that their credit's going to get better. The credit's actually going to go down, and it's because they're eliminating the available credit, right? And some of those credit cards could have longer
Histories.
lifetime on it, right? The credit history with them could be longer,
Yeah.
which that definitely messes with you. And
Yep. And
it's definitely something that most people don't even think about because they think, oh, credit card's bad, close it out. That's not
yeah,
the way you handle it. You
and
got to
this is
manage it.
this is an interesting scenario too, because if you have high credit card debt, right, your credit utilization is high, which is bringing down your credit score. Whereas if you use a term loan to pay them off, you still get the age of that line and your credit utilization is going way down. So this will actually increase your credit score, improve your credit score going into a more challenging time. That's why I think this is a perfect program for someone that has a lot of credit card debt. And it's really not that hard to qualify. 650, 660, 670 credit or better. And then you just need your last two pay stubs or a tax return showing, what your provable income is. And as long as it's over 50,000 a year, you should be in that wheelhouse and you should be good. Now, what else do we see clients using that for, Brian?
So we've seen clients use this to help start up their businesses, right? Do what we call side hustles, gigs, um, you know,
Coaching,
coaching. Really, I mean, there's the use is really, I mean, it's
anything.
anything you want to do. So home improvements, I mean, you name it, and you could do it with these types of loans. Difference is these loans are completely unsecured, which I'm not sure if we mentioned that before, which means there's nothing tied to collateral. Um, so basically, they issue you the loan, and it's based on your word that you're going to repay it, which everybody will. But it's a really great opportunity to get that little cash injection if you need it.
Awesome. Yeah, I mean, and let's talk about why someone may go this route as opposed to the SBA.
These are going to be much quicker turnaround time versus the SBA. So, I mean, approval is usually within 24 hours. Depends on how you get paid, right? So if you have a if you're a W-2 or salaried employee, chances are we get you funded within 1 to 3 business days, right? If you are self-employed, it's going to take a little bit longer, but we can still get it done probably within 5 to 7 business days. So it's very much a quicker turnaround time than the SBA itself.
I love it. And we have somebody asking, what is the max DTI on a term loan?
Max DTI, I mean, it varies, right? So if the DTI is high based off of credit card debt, so they do leverage that a little bit differently. So you could be up 55, 60%. If it's not based on credit card debt, if it's just anything else, I recommend anything under 40%. So that's going to be a big difference.
So the one place I would say, the one time I would say it's not advantageous to use this, right, is if you're going to go buy a house, right? If you're looking to purchase a house in the next 6 to 12 months, I steer people away from this program. Otherwise, it can be used to consolidate debt, start a business, pay for coaching, consulting, really anything. And it's not going to impact your credit in a negative way. The reason I say stay away from it if you're purchasing a home, because it can show up on your credit report, and that would impact your DTI ratios when you're going to apply for a mortgage. The other thing is like, hey, these usually range anywhere from $20 to $150,000. So the difference is between an SBA, like SBAs are not approving startups. They only approve SBA approved franchises. And typically an SBA approved franchise is not going, they're going to need more than, 100,000 or 150,000. But this program, I think it's 30 to 40% of our clients opt for this program because it's quick, it's simple, it's easy, longer terms, monthly payments, and it's cheap. Me personally, I don't mind sharing it. I actually took two while I was waiting for some money to clear, and worked out great. Thank you, Ryan. Appreciate you. We got that done in 3 days.
Surprisingly enough, right?
Yeah.
I mean, I practice what I preach, right? So I took out 2 of these loans when I started my business, and same with the credit cards. Like I used one of these loans to pay off credit cards. That was my very first loan that I took out. Funny story, actually. I didn't realize because I was so new at doing it. I didn't ask questions, and I accidentally signed for 2 loans, so I got funded $40,000. And I ended up having to make some phone calls and get one pulled back out of the bank. Thank goodness it was within the 72-hour time frame. But that's a good thing. Why work with us? We're going to make sure steer clear of the different crazy scenarios that could potentially happen, and unless we do all the research and everything for you.
Nice. Any other things that you want to add?
Yeah. So one thing when I really started up front, we talked about there's debt consolidation, debt settlement. So debt consolidation is not a dirty word, right? Debt consolidations means you're just consolidating all of those payments into one payment, right?
which is probably going to be way lower.
Correct. Correct. Now, debt settlement, that's when you stop paying like on your credit cards or whatever, and then you funnel your money through like another company or lawyer. Then you change all your phone information on those credit cards. They call the lawyer, then the lawyer settles for less, and that's going to hurt your credit. So that's the big difference. So
Yeah,
debt settlement will be negative towards your credit, even though they may be able to do it like a little bit lower, but it's going to affect you for the next 10 years, 11 years technically. And then after that, um, you know, it's just really the debt consolidation is much better loan
yeah.
option.
And the reason I think this is so important now, guys, is to free yourself from, the shorter term debt, the revolving debt, as we go into this, challenging time with the economy. I think that's crucial. The other thing is, if you own a business or if you're looking to start a business, having the strongest credit possible is so important. And if you can use this to do that, I think you'll be in a much better position to get rid of those credit cards and not get rid of them, but pay them down and put yourself in a strong cash position. It'll give you and the business the best chance of surviving and thriving. So, hope this really makes sense. Ryan, do you have anything
No,
else?
you actually just brought up a really valid point that I'm glad that we talked about because I've seen this before. So let's just say you do the debt consolidation, you pay off all your credit cards. Make sure you are charging up. Make sure you're keeping those accounts active, especially in times like this because last time I think it was 2009. This again happened to me. I stopped using a card,
Mm-hmm.
right? And they end up shutting the card down. No, they didn't shut it down. They reduced
Yep.
the credit limit from 6,000 to 3,000, and I had an amount, a charged up amount somewhere else, and like so, it like my credit score dropped by like 30, 40. It was crazy because at the time I didn't have a lot of credit, and it really affected me. So. The key is to make sure that in times like this, make sure that you are using those cards but you want to pay them off within that 30-day time frame so you don't get charged any interest.
Yeah, guys, what Ryan's saying real quick is in times that when the banks know the economy's in a challenging position, which is what we're into and certainly heading down with stagflation, everything we discussed yesterday, what they'll do is they will reduce credit lines, they will reduce credit cards, and they don't necessarily advertise that they're doing this. So Ryan's saying he had, a $5,000 limit or $6,000 limit with 3,000 on a card. Well, they reduced it, cut it in half to 3,000. What that does is it shoots up his DTI, debt to income ratio, and his credit utilization, and drops your credit. All right, it's very important to have strong credit throughout this in order to one, take advantage of opportunities, and two, be prepared if you do need other types of financing to be in a strong position to get it. So, guys, I appreciate you guys tuning in. I hope this helped. You guys need, if you're looking into doing this, you want to consolidate credit cards, you want to start a business, just reach out to us. We're here to help. Mention that you saw this, and we will do everything in our power to help you. Thank you for tuning in, and we will see you tomorrow.